Goodwill is a unique intangible asset. Unlike other assets, goodwill's cost can't be directly associated with any specific identifiable right and is not separable from the company as a whole. Because of this unique characteristic, we can't measure the impairment of goodwill the same way as we do other assets. By its very nature, goodwill is inseparable from a particular reporting unit. A reporting unit is an operating segment of a company or a component of an operating segment for which discrete financial information is available, and segment management regularly reviews the operating results of that component. Measuring goodwill impairment is a two-step process. Let's compare the two-step process for measuring goodwill impairment with the two-step process for measuring impairment for property, plant, equipment, and finite life assets. In step 1, for all classifications of assets, we decide whether a write-down due to impairment is required by determining whether the value of an asset has fallen below its book value. However, in this comparison, the value of assets for property, plant, and equipment and finite life intangible assets is considered to be value in use as measured by the sum of undiscounted cash flows expected from the asset. But due to its unique characteristics, the value of goodwill is not associated with any specific cash flows and must be measured in a unique way. So by its very nature, goodwill is inseparable from a particular reporting unit. So for this step, we compare the value of the reporting unit itself with its book value. If the fair value of the reporting unit is less than its book value, an impairment loss is indicated. In step 2, for all classifications of property, plant, and equipment and intangible assets, if impairment is indicated from step 1, then we measure the amount of impairment as the excess of the book value of the asset over its fair value. But unlike other assets, the fair value of goodwill cannot be measured directly, which is the market value, the present value of associated cash flows, and so it must be implied from the fair value of the reporting unit that acquired the goodwill. The implied fair value of goodwill is calculated in the same way that goodwill is determined in a business combination. That is, it's a residual amount measured by subtracting the fair value of all identifiable net assets from the purchase price using the unit's previously determined fair value as the purchase price. If goodwill is tested for impairment at the same time as other assets of the reporting unit, the other assets must be tested first, and any impairment loss and asset write-down is recorded prior to testing goodwill. Subsequent reversal of a previous goodwill impairment loss is not allowed. So prior to 2012, companies were required to perform step 1 of the two-step test for goodwill impairment at least once a year, as well as in between annual test dates if something occurred that would indicate that the fair value of the reporting unit was below its book value. Then, if the first step indicated that the fair value of the reporting unit was below book value, the company would perform step 2 to measure the amount of goodwill impairment. In response to concerns about the cost and the complexity of performing step 1 every year, FASB now allows companies the option to decide whether step 1 is necessary. Companies selecting this option will perform a qualitative assessment by evaluating relevant events and circumstances to determine whether it is more likely than not, A, likelihood of more than 50% is what that means, that the fair value of a reporting unit is now less than its book value. Only if that's determined to be the case will the company perform the first step of the two-step goodwill impairment test. Because the book value of the net assets of $440 million exceeds the $360 million fair value of the reporting unit, an impairment loss is indicated. So let's look at this. Upjohn Corp. acquired Pharmacopoeia Corp. for $500 million. Upjohn recorded $100 million in goodwill related to this acquisition because the fair value of the net assets of Pharmacopoeia was $400 million. After the acquisition, Pharmacopoeia continues to operate as a separate company and is considered a reporting unit. At the end of 2018, events and circumstances indicated that it is more likely than not that the fair value of Pharmacopoeia is less than its book value, requiring Upjohn to perform step 1 of the goodwill impairment test. The book value of Pharmacopoeia's net assets at the end of 2018 is $440 million, including the $100 million in goodwill. On that date, the fair value of Pharmacopoeia is estimated to be $360 million, and the fair value of all of its identifiable tangible and intangible assets, excluding goodwill, is estimated to be $335,000. So the impairment loss is $75 million, determined as you see here on this slide. Now the entry to record the loss is shown here as a loss on impairment of goodwill and a credit to goodwill. The loss normally is reported in the income statement as a separate component of operating expenses. So let's take a look at a concept check. In 2017, Mochan acquired Sanchez and recorded goodwill of $290 million as a result. The net assets, including goodwill from Mochan's acquisition of Sanchez Company, had a 2018 year-end book value of $1,160 million. Mochan assessed the fair value of Sanchez at this date to be $1,020 million, while the fair value of all Sanchez's identifiable tangible and intangible assets, excluding goodwill, was $900 million. The amount of the impairment loss that Mochan would record for goodwill at the end of 2018 is $170 million. So the way we will do that, the implied fair value of goodwill would be $120 million, which is the 1,020 less the 900, which gives us our $170 million. The impairment loss is going to be the $290 million minus the $120 million, which gives us the $170 million. Under U.S. GAAP, it is based on a reporting unit, a segment, or a component of an operating segment for which discrete financial information is available. But under IFRS, it's based on the cash generating unit, the lowest level at which goodwill is monitored by management. A CGU, or a cash generating unit, can't be lower than a segment. Under GAAP, it's a two-step process. First, we compare the fair value of the reporting unit with its book value. A loss is indicated if fair value is less than book value. Then the impairment loss is the excess of book value over the implied fair value. Under IFRS, it's just a one-step process. We compare the recoverable amount of the CGU to book value. If the recoverable amount is less, we reduce goodwill first, then the other assets. The recoverable amount is the higher of fair value less cost to sell and value in use, which is called the present value of the estimated future cash flows. IAS number 36 requires that goodwill be tested for impairment at least annually. GAAP allows a company to avoid annual testing by making qualitative evaluations of the likelihood of goodwill impairment to determine if step 1 is necessary. Both GAAP and IAS number 36 prohibit the reversal of goodwill impairment losses. These are assets that management has actively committed to immediately sell in their present condition and for which sale is probable. An asset or group of assets classified as held for sale is measured at the lower of its book value or fair value less the cost to sell. An impairment loss is recognized for any write-down to fair value less cost to sell. Except for including the cost to sell, notice the similarity to impairment of assets to be held and used. We don't depreciate or amortize these assets while classified as held for sale, and we report them separately in the balance sheet. This slide summarizes the guidelines for the recognition and the measurement of impairment losses. So let's just take a moment and go through these. So those assets that are held and used, like PP&E and intangible assets with a finite life, when we test for impairment, it's when events or circumstances indicate that the book value may not be recoverable. It's a two-step process. An impairment loss is required only when the book value is not recoverable, which is the undiscounted sum of estimated future cash flows are less than the book value. Then, with step 2, the impairment loss is the excess of book value over the fair value. Now, those intangibles with an indefinite life apart from goodwill should be tested annually or, if needed, more frequently. And if book value exceeds fair value, an impairment loss is recognized for the difference. Now, this is only for indefinite intangibles. Goodwill has a two-step process. Step 1 is a loss is indicated when the fair value of the reporting unit is less than its book value. Then we go to step 2. An impairment loss is measured as the excess of book value over the implied fair value. Last, those that are held for sale, those assets, we no longer depreciate because it's probable we're going to be selling them in the current period. If book value exceeds fair value, less the cost to sell, an impairment loss is recognized for the difference. We now can add asset impairment losses to the list of the big bath accounting techniques some companies use that manipulate earnings. By writing off large amounts of assets, companies significantly reduce earnings in the year of the write-off, but are able to increase future earnings by lowering future depreciation, depletion, or amortization. Here's how they do it. We measure the impairment loss as the difference between an asset's book value and its fair value, but In most cases, fair value must be estimated, and the estimation process usually involves a forecast of future net cash flows the company expects to generate from the asset's use. So if a company underestimates future net cash flows, fair value is understated. This has two effects. The current year's income is unrealistically low due to the impairment loss being overstated. And then future income is unrealistically high because depreciation or depletion or amortization are based on those understated asset values. Now another concept question for impairment. Jasper owns a patent for which it paid $82 million. At the end of 2018, it had accumulated amortization on the patent of $14 million. Due to adverse economic conditions, Jasper's management determined that it should assess whether an impairment loss should be recognized for the patent. The estimated undiscounted future cash flows to be provided by the patent total $42 million, and the patent's fair value at that point is $32 million. Under these circumstances, Lester would record a $36 million impairment loss on the asset. So the way we figure that is the $82 million which we paid for it minus the amortization of $14 million gives us the $68 million. The $68 million and the fair value of $32 million gives us the $36 million in an impairment loss. So many long-lived assets require expenditures to repair, maintain, or improve them after their acquisition. A choice must be made between capitalizing the expenditures by either increasing the asset's book value or creating a new asset or expensing them in the period in which they are incurred. Usually we capitalize expenditures that are expected to produce benefits beyond the current fiscal year. In contrast, expenditures that simply maintain a given level of benefits are expensed in the period they are incurred. Expenditures related to assets can increase future benefits in the following ways: an extension of the useful life of the asset, an increase in the operating efficiency of the asset resulting in either an increase in the quantity of goods or services produced or a decrease in future operating costs, and an increase in the quality of the goods or services produced by the asset. Expenditures that cause any of these results should be capitalized initially and then expensed in future periods through depreciation, depletion, or amortization. This permits the matching of the expenditure with the future benefits. Of course, materiality is an important factor in just the practical application of this approach. There often are practical problems in capitalizing these expenditures. So, for example, even if future benefits are increased by the expenditure, it might be difficult to determine how long the benefits will last. It's important for a company to establish a policy for treating these expenditures and to apply it consistently. For convenience, many companies set materiality thresholds for the capitalization for any expenditure. So, an example, a company might decide to expense all expenditures under $1,000 regardless of whether or not future benefits are increased. Judgment is required to determine the appropriate materiality threshold as well as the appropriate treatment of expenditures over $1,000. Subsequent expenditures can be classified as repairs and maintenance, or additions, improvements, and rearrangements. These expenditures are made to maintain a given level of benefits provided by the asset and do not increase future benefits. So, for example, the cost of an engine tune-up or the repair of an engine part for a delivery truck just allows the truck to continue its productive activity. But if the maintenance isn't performed, the truck's not going to provide the benefits originally anticipated. So in that sense, future benefits are provided without the repair. The truck's no longer going to operate. But the key here is that future benefits are not provided beyond those originally anticipated. Expenditures for these activities should be expensed only in the period incurred. So as the term applies, additions involve adding a new major component to an existing asset, and those should be capitalized because future benefits are increased. Adding a refrigeration unit to a delivery truck increases the capability of the truck, so it also increases its future benefits. Other examples could include the construction of a new wing of a building, the addition of a security system to an existing building. In this case, the capitalized cost includes all necessary expenditures to bring the addition to a condition and location for use. For a building addition, this might include the costs of tearing down and removing a wall of the existing building. The capitalized cost of additions is depreciated over the remaining useful life of the original asset or its own useful life, whichever one is shorter. Expenditures classified as improvements involve the replacement of a major component of an asset. Now, the replacement can be a new component with the same characteristics as the old component, or it could be a new component with enhanced operating capabilities. The cost of the improvement usually increases future benefits and should be capitalized by increasing the book value of the related asset and depreciated over the useful life of the improved asset. So, an example. An existing refrigeration unit in a delivery truck could be replaced with a new but similar unit or with a new and improved refrigeration unit. There are three methods used to record the cost of improvements. We can treat it as a substitution, capitalization of new cost, reduction of accumulated depreciation. So the improvement can be recorded as both a disposition of the old component and the acquisition of a new component. This approach is conceptually appealing, but it is practical only if the original cost and accumulated depreciation of the old component can be separately identified. Another way to record an improvement is to include the cost of the improvement, net of any consideration received from the disposition of the old component, as a debit to the related asset account without removing the original cost and accumulated depreciation of the original component. Now, this approach is acceptable only if the book value of the original component has been reduced to an immaterial amount through prior depreciation. And then another way to increase an asset's book value is to leave the asset account unaltered, but decrease its related accumulated depreciation. The argument for this method is that many improvements extend the useful life of an asset and are equivalent to a partial recovery of previously recorded depreciation. This approach produces the same book value as the capitalization of cost to the asset account, but the cost and accumulated depreciation amounts will differ under the two methods. So under the substitution method, we would record a journal entry for the disposition of the old component, accumulated depreciation on the building through the date of replacement of $160,000, and parts of the old system sold for $12,000 get debited. The actual cost of the air conditioning system included in the cost of the building of $200,000 is credited. The difference between the building of $200,000 and the sum of cash of $12,000, along with the accumulated depreciation of $160,000, is recorded on the debit side as a loss on disposal of $28,000. Under the substitution method, a journal entry is also recorded for the acquisition of the new component. So here the old system was removed and the new system is installed at a cost of $230,000, which was paid in cash. Since there's an increase in buildings, the building account gets debited for $230,000 and cash is credited for the same amount. Now, under the capitalization of new cost method, the original cost and accumulated depreciation of the original component are not removed. The building account is debited for $218,000, which is the difference between the actual cost of the new building, which is $230,000, and $12,000, the amount received for the sale of the parts of the old system. Since cash is paid for the purchase of the new building of $230,000 and cash of $12,000 is received for the sale of the parts of the old system, cash is credited for the difference of $218,000. Under the reduction of accumulated depreciation method, the building's account is left unaltered, but its related accumulated depreciation is decreased. The book value is the same as in the capitalization of cost method, but the cost and the accumulated depreciation amounts differ under each method. Accumulated depreciation of buildings is debited for $218,000 and cash is credited for the same amount. Expenditures made to restructure an asset without addition, replacement, or improvement are termed rearrangements. The objective is to create a new capability for the asset and not necessarily to extend its useful life. Examples include the rearrangement of machinery on the production line to increase operational efficiency, and the relocation of a company's operating plant or office building. If these expenditures are material and they clearly increase future benefits, then they should be capitalized and expensed in future periods that are benefited. If the expenditures are not material or if it's not certain that future benefits have increased, then they should be expensed in the period in which they were incurred. So this slide here provides a summary of the accounting treatment for the various types of expenditures related to property, plant, and equipment. And let's just take a moment to review. Any repairs and maintenance just maintain a given level of benefits, and in that case they're just expensed in the current period. Additions would include the addition of a new major component to an existing asset, and in that case they're capitalized and depreciated over the remaining useful life of the original asset or its own useful life, but the key here is whichever one is shorter. An improvement is the replacement of a major component, and again they're capitalized over the useful life of now the improved asset. Then rearrangements, expenditures to restructure an asset without addition, replacement, or improvement. If they're material and you can see that they do increase future benefits, then we do capitalize and depreciate them over the future benefits that they benefit. Now, repairs, additions, improvements, and rearrangements generally relate to property, plant, and equipment. A possible significant expenditure incurred subsequent to the acquisition of intangible assets is the cost of defending the right that gives the asset its value. So if an intangible asset is successfully defended, now that's the key, successfully, the litigation costs should be capitalized and amortized over the remaining useful life of the related asset. This is the appropriate treatment of these expenditures, even if the intangible asset was originally developed internally rather than purchased. Because as we know, intangibles developed internally get expensed, but any type of litigation costs that successfully defended would be capitalized. But if the defense is unsuccessful, then the intangible asset doesn't have a future value. In this case, litigation costs don't provide a future benefit, and so they should be expensed. The book value of the intangible asset then should be reduced to the realizable value. So here's an example. If a company is unsuccessful in defending a patent infringement suit, the patent's value might be eliminated and a loss is then recorded. So let's take a look at a concept question. Which of the following terms describes expenditures made to maintain a given level of benefits? Repairs and maintenance, additions, improvements, or rearrangements? I hope you guys get this. It is A. Repairs and maintenance are made in order to maintain rather than improve the benefits associated with a given asset. Those are expensed in the period in which they were incurred. So let's take a look now at problem 11.4. On April 1st of 2016, the KB Toy Company purchased equipment to be used in its manufacturing process. The equipment cost $64,600, has a 10-year useful life, and no residual value. The company uses the straight-line depreciation method for all its manufacturing equipment. On January 4th of 2018, $15,600 was spent to repair the equipment and to add a feature that increased its operating efficiency. Of the total expenditure, $3,500 represented ordinary repairs and annual maintenance, and $12,100 represented the cost of the new feature. In addition to increasing operating efficiency, the total useful life of the equipment was extended from 10 years to 12-year useful life. Prepare the journal entries for the depreciation for 2016 and 2017. So, in 2016, we have the $64,600 divided by a 10-year life. But since this asset was purchased in April, we only have 9 months during the year. So 9/12 would be $4,845. Now in 2017, we would take the entire 12 months. So the $64,600, divide that by 10 years, would be a depreciation expense of $6,460 with the corresponding accumulated depreciation as the credit. Then, our next job is to prepare the journal entry for the 2018 expenditure. So we know the portion that are ordinary repairs and annual maintenance are expensed in the current period. That $3,500 is an expense, which we would debit repairs and maintenance expense of $3,500, but the $12,100 will be capitalized. So we'll debit equipment for $12,100 and credit our cash. Then the journal entries for depreciation in 2018. So we've added some to equipment, and we've also need to be aware that we've extended the useful life from 10 years to 12 years. So we need to figure out the basis to date. We take the original cost minus the depreciation for 2 years to give us the undepreciated cost, add that asset addition of $12,100 to come up with a new depreciation base. Then from there, we are going to divide that by the remaining life. The remaining useful life is 10.25 years. So what we're going to do is take the depreciable base, divide that by the remaining life to come up with a new annual depreciation of $6,380. Under U.S. GAAP, litigation costs to successfully defend an intangible right are capitalized and amortized over the remaining useful life of the related intangible. But under IFRS, these costs are expensed, except in rare situations when an expenditure increases future benefits. So let's look at this concept question. Robertson, Inc. prepares its financial statements according to international financial reporting standards. At the end of its 2018 fiscal year, the company chooses to revalue its equipment. The equipment cost of $565,000 had accumulated depreciation of $248,000 at the end of the year after recording annual depreciation, and had a fair value of $340,000. $238,000. After the revaluation, the accumulated depreciation account will have a balance of, as you see here, the $248,000 accumulated depreciation times the $338 divided by the $317,000 gives us the $264,429. So depreciation for financial reporting purposes is an attempt to distribute the cost of the asset less any anticipated residual value over the estimated useful life in a systematic and rational manner that attempts to match revenues with the use of the asset. Depreciation for income tax purposes is influenced by the revenue needs of government as well as the desire to influence economic behavior. For example, accelerated depreciation schedules currently allow or are intended to provide an incentive for companies to expand and modernize their facilities, thus stimulating economic growth. The Federal Income Tax Code allows taxpayers to compute depreciation for their tax returns on assets acquired after 1986 using the Modified Accelerated Cost Recovery System. We call this MACRS. Under MACRS, each asset generally is placed within a category, which is a recovery period category. The 6 categories for personal property are 3, 5, 7, 10, 15, and 20 years. For example, the 5-year category includes automobiles, light trucks, and computers. Key differences between the calculation of depreciation for financial reporting and the calculation using MACRS are related to the estimated useful lives and residual values are not used in MACRS. Firms can't choose among various accelerated methods under MACRS, and a half-year convention is used in determining the MACRS depreciation amounts. Depending on the category, fixed percentage rates are applied to the original cost of the asset. The rates for the 5-year asset category are shown here. These rates are equivalent to applying the double declining balance method with a switch to straight line in the year straight line yields an equal or higher deduction than the double declining balance method does. In most cases, the half-year convention is used regardless of when the asset is placed in service. Retirement and replacement depreciation methods occasionally are used to depreciate low-valued assets with short service lives. Under either approach, an aggregate asset account that represents a group of similar assets is increased at the time the initial collection is acquired. Using the retirement depreciation method, the asset account also is increased for the cost of subsequent expenditures. When an item is disposed of, the asset account is credited for its cost. Depreciation expense is recorded for the difference between cost and proceeds received. No other entries are made for depreciation. As a result, one or more periods may pass without any expense of depreciation recorded. Shown on this slide, this journal entry records the purchase of 100 handheld calculators at $50 acquisition cost each. If 20 new calculators are acquired at $45 each, then the asset account is increased. See the first entry shown here. 30 calculators are disposed or retired by selling them secondhand to a bookkeeping firm for $5 each. The second journal entry shown reflects the retirement method. Note that the retirement system assumes FIFO cost flow approach in determining the cost of assets, $50 each, that were disposed of. By the replacement depreciation method, the initial acquisition of assets is recorded the same way as by the retirement method, which is the aggregate cost is increased. However, depreciation expense is the amount paid for new or replacement assets. Any proceeds received from asset dispositions reduces depreciation expense. For our example, the acquisition of 20 new calculators at $45 each is recorded as depreciation in the journal entry, as you see here. The sale of the old calculators is recorded as a reduction of depreciation, as shown on this slide. The asset account balance remains the same throughout the life of the aggregate collection of assets. Because these methods are likely to produce aggregate expense measurements that differ from individual calculations, retirement and replacement methods are acceptable only in situations where the distortion in depreciation expense does not have a material effect on income. These methods occasionally are encountered in regulated industries, such as the utility sector. There you have it. We've completed Chapter 11. I hope you have a good day, guys.